Welcome back to the ProTicker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
We are diving deep into a stack of sources today. We've got Yahoo Finance, CNBC, Bloomberg.
And we're trying to figure out exactly what kind of financial year 2025 was and, more importantly, what it means for 2026.
Yeah, we're really dissecting a market that's built on these high-stakes contradictions right now.
Contradictions is the right word.
On the surface, you've got the U.S. enjoying record highs, mostly fueled by AI enthusiasm. But when you look closer, you find crippling corporate debt, a labor market that saw over 1 million people laid off.
1 million people.
And a Federal Reserve that is so fractured, it can barely agree on a tiny 25 basis point move.
So that's our mission, right? To find those contradictions and give you the essential context. We're going to analyze the market's paradoxical strength.
Yeah.
Dig into why Oracle has become sort of the face of AI bubble fears.
And that brutal job market.
Yes. And we'll end with a $200 billion lesson in emotional capital allocation from Warren Buffett himself. Okay, let's unpack this with a global market snapshot from this, thin holiday week.
Let's do it. Starting with the U.S., stock futures are holding pretty steady in this post-Christmas environment. That's according to Yahoo Finance.
Right.
But the big story is really the year we just had. The S&P 500 and the Dow, they both closed at new record highs on Christmas Eve.
And numbers are huge.
They are. We're talking about the S&P 500 being up, 18% year to date? And the NASDAQ composite is up over 20% for 2025.
It's just so hard to reconcile that level of performance with the monetary outlook, though.
Yeah.
The data shows this massive Santa Claus rally is persisting even as the expectations for an early 2026 Fed rate cut just shrink.
But they're evaporating. Less than 15% of traders are betting on a January cut now. It feels like the market has just decided to ignore any and all monetary pessimism.
So what force is strong enough to override the Fed?
Well, that speaks to the concentrated power of AI and tech, but we'll get to that. First, let's jump over to Asia.
Okay.
So CNBC is reporting that markets there generally edged higher today, Friday. Japan's Nikkei 225 climbed 0.68%, helped by tech names like SoftBank, which was up 1.8%.
And South Korea, too?
South Korea's Kospi also added about 0.5%.
But the key takeaway from the region isn't just the trading volume, it's the inflation data coming out of Japan, right?
Absolutely. Tokyo Core CPI rose 2.3% year over year in December. What's critical here is that this was below the 2.5% that was expected, and it's a notable drop from 2.8% in November.
And that Tokyo number is always a key leading indicator.
Always. It gives you a preview of the nationwide trends. So if inflation is softening there, it gives the Bank of Japan some much-needed breathing room on their own tightening.
So if inflation is cooling in Asia, why is the market still pricing in so much risk and, frankly, fear?
That is the perfect question, and the answer is, in the historic surge we're seeing in precious metals, it's been truly remarkable.
A scorching run. For gold, silver, and platinum. This is across both CNBC and Bloomberg sources. Let's quantify this for everyone because the numbers are just huge.
They really are. Gold is trading above $4,530 an ounce. That's up about 70% year to date. But silver is the real headline grabber.
Over 150%.
Over 150% in 2025, crossing $75 an ounce. This historic run is being driven by, multiple forces. You had the 3 Fed rate cuts, a weakening dollar, and critically, this is where investors are fleeing.
The fear trade.
The ultimate fear trade. Geopolitical uncertainty and just this deep-seated skepticism about the stability of the high-flying AI stocks.
And on silver specifically, we should probably mention that historic short squeeze back in October.
Oh, for sure. That speculative inflow just massively amplified the whole thing, pushing it way beyond just industrial demand.
And platinum's in on it, too.
Absolutely. Platinum has joined the party, spiking over 40% this month alone, but unlike gold and silver, which are driven by fear and speculation, platinum is facing a real physical shortage.
Right, its third straight annual supply deficit.
Exactly, and that's largely due to disruptions in South Africa.
We're also seeing those geopolitical drivers hitting oil. Bloomberg's reporting on that. Brent crude is trading above $62 a barrel, heading for its biggest weekly gain since October.
Yeah, and the rise is being attributed to the U.S. blockade of crude from Venezuela and a U.S. military strike against Islamic State in Nigeria.
An OPEC member.
Right. But that short-term volatility, it really masks the broader macro context. Despite this weekly jump, Brent is still set for a 16% annual decline overall.
So the long-term view is still a glut.
The structural reality remains an expected global glut in 2026, which continues to cap prices.
So We have record stock prices, fear-driven metal surges, and oil reacting to instability. It's a very, very mixed picture.
It is.
Now let's turn to the labor market, because that's where the contradiction hits hardest. Yahoo Finance ran a headline, and I'm quoting, "2025 was a brutal year for layoffs."
Brutal is an understatement. This is where the market strength just feels deceptive. Through November, layoff announcements totaled 11,170,821 jobs.
Wow. That is a truly staggering number. It's a 54% rise from the same period in 2024.
And these weren't small, struggling companies. We saw cuts across massive sectors.
Right. UPS cut 34,000 operational roles and another 14,000 in management. Verizon had its largest ever campaign, cutting over 13,000. Amazon shed 14,000 corporate roles.
All of this pushed the unemployment rate up to 4.6% in November. That's a 4-year high if you exclude the pandemic recovery.
So what's the central debate here? Is this AI replacing jobs, or is this just a post-pandemic correction?
That's what the sources are wrestling with. You have Amazon CEO Andy Jassy, who positioned the cuts as being driven by overgrowth, cultural layers. He argued it wasn't really AI-driven, not right now at least.
And some economists like Timothy DiStefano, they echo that. They call it a necessary correction. But here's the nuance, right?
What's that?
Even if the initial decision isn't AI, the subsequent hiring rate is incredibly weak. It's hovering near 2013 levels.
It's creative destruction. But for the 1 million plus people involved, finding a new role is just so much harder than in previous cycles. And don't forget, Meta even announced cuts within its own AI unit.
Right. So even the highest growth areas are feeling the squeeze.
Exactly. And the turbulence we see in the job market, that really defined the Federal Reserve's year, too.
Yeah, Yahoo Finance detailed how the Fed spent 2025 struggling with the conflict between its dual mandate, maximum employment, which was softening, and stable prices, where inflation was just stubborn.
And that tension was really complicated by external factors.
You mean President Trump's tariffs, the April 2nd Liberation Day thing?
That's the one. Those tariffs rattled markets and made the inflation outlook much, much harder to predict. The Fed ended up responding with 3 insurance rate cuts through the fall, starting in September.
Right after the labor market cracks became undeniable in July and August.
But the internal divisions, they became truly blatant in December. The rate cut passed, but it saw 3 dissents. That's a very high number for a body like that.
Okay, so break that down.
You had 2 members, Goolsbee and Schmid, who wanted to hold steady because of inflation. Their position was clear. Don't risk prices reaccelerating just to soothe a moderately weakening labor market.
But then you had the third dissenter, Marin, who wanted a more aggressive 50 basis point cut.
Exactly. That reflects the concern that the employment picture was getting worse too quickly and that the Fed needed to act decisively to, stave off a recession.
It's just a messy picture. The Fed is signaling a cautious start to 2026, expecting only one more cut.
And with a new Fed chair who is expected to favor lower rates coming in next year, they face a serious challenge building consensus if voting members like Hammack and Logan keep prioritizing sticky inflation.
Okay, let's move to the AI investment conflict, because this is where the contradictions become truly volatile. We're seeing record growth alongside some really aggressive leverage.
And let's start with Oracle, which Yahoo Finance called the poster child for AI bubble fears.
Their stock just soared early in the year, right? After they announced that massive $500 billion Stargate joint venture with OpenAI and SoftBank.
It was pure AI euphoria, but then the debt reality set in. Oracle issued nearly $26 billion in bonds this year, increasing its total debt to $124 billion.
And crucially, the cost of insuring that debt.
The CDS spreads, they hit their highest level since 2009.
A 16-year high. That tells you everything about Wall Street's anxiety. But here's where it gets surprising. Analysts spotted a footnote in a recent SEC filing.
The hidden commitments?
$248 billion in additional lease commitments, mostly for future data centers, starting in fiscal 2026-2028.
I mean, that is nearly $250 billion in hidden obligations. As one Morningstar analyst put it, these huge off-balance sheet commitments plus the debt leaves Oracle with very little room for error.
And that operational risk is coupled with customer risk, isn't it? The dependency on OpenAI is huge. It accounts for at least $300 billion of their future revenue.
And Wall Street is rightly questioning whether OpenAI can even meet its own massive revenue targets, especially with the rising threat from Google.
This illustrates that fundamental market differentiation that CNBC highlighted.
Yes, the splintering AI market. Investors are finally distinguishing between the AI spenders and the AI infrastructure firms.
which means we have to challenge the initial valuation models. For years, we valued companies like Meta and Amazon as these CapEx-light software firms.
Right.
But now they're just spending colossal sums on data centers. They're becoming asset-heavy.
We absolutely should be challenging it. Their risk profile has fundamentally changed. When hardware depreciation costs start hitting their P&L statements next year, their earnings will look dramatically different. They are consumers of capital.
And the infrastructure winner, the monetizer of all this spending, is still NVIDIA.
No question. CNBC reported on its record $20 billion acquisition of Groq's assets and IP.
For their inference technology.
Exactly. And Groq's founder, who helped create Google's TPU chip, is joining NVIDIA. It just cements their dominant position.
Okay, so on the complete opposite end of that spectrum, we have Palantir. This story really shows the disconnect between retail mania and institutional skepticism.
An indisputable retail darling. I mean, individual investors bought nearly $8 billion in Palantir stock on balance in 2025. That's an 80% increase from the prior year.
Which makes Palantir the fifth most bought security, behind only Tesla, NVIDIA, and the SBY ETF. The stock surged more than 150% in 2025.
And yet, Wall Street analysts maintain a consensus hold rating. They cite what D.A. Davidson called a non-starter valuation multiple.
And what is that multiple?
It's around 450 times trailing earnings. To put that into perspective for you, the average S&P 500 company is valued at around 28 times.
So 450x. That's just baking in perfect performance forever.
Indefinitely. It requires decades of extreme growth. Even Michael Burry, from The Big Short, has bet against it.
So the contrast is purely emotional. Retail investors see destiny. They see a monopoly on AI defense contracts.
And that narrative, plus CEO Alex Karp's charismatic leadership, it appeals directly to that cohort, no matter what the institutions are saying.
We need to pivot away from tech for a minute to cover a story that will hit consumers pretty hard. The hidden cost of the leather trade war. CNBC detailed this.
And this is a perfect storm of inflationary factors for things like handbags, boots, couches.
It's driven by three things at once. First, the tariffs from April. Second, the massive supply chain disruption from companies rushing production out of China.
Right, causing bottlenecks in Vietnam and Cambodia.
And third, a domestic raw material shortage.
The U.S. cattle herd, it's at its smallest size since the 1950s, which means fewer hides for global consumption.
So analysts are projecting prices for leather goods will rise approximately 22% over the next 1 to 2 years. Companies like Tapestry, who owns Coach, have already warned of $160 million in tariff expenses.
And the ironic outcome is that instead of restoring U.S. manufacturing, companies are just reshuffling suppliers overseas. Production isn't coming home.
Okay, before we get to our final big lesson, let's quickly mention a feature update that'll be a huge quality of life win for a lot of people.
The Gmail one.
Yes. CNBC reports Google is finally rolling out the ability for users to change their show Woodat at gmail.com address without losing any data.
Finally, no more being stuck with that embarrassing high school email address.
And the old address remains an alias, which is important. Interestingly, the feature was first discovered on the Hindi support page, so it suggests a phased rollout starting there.
Okay, let's talk about capital allocation failure on a grand scale. Specifically, Warren Buffett's reflection on his dumbest stock ever bought, which, according to CNBC, was Berkshire Hathaway itself.
This story is legendary because it was driven purely by emotion. Spite.
Pure spite. Back in 1964, Buffett bought control of the struggling textile company because the CEO, Seabury Stanton, chiseled him out of 1/8 of a point on a tender offer.
Just a fraction of a dollar. Planned to sell at $11.50, but Stanton only offered 11.375 fats.
And that fractional difference triggered a revenge trade. Buffett then fought that doomed textile business for 20 years. He estimates that committing capital there instead of focusing on the insurance business cost Berkshire $200 billion.
$200 billion in lost opportunity.
It's a priceless lesson, and it really connects to our current market. The lesson, as he famously put it, if you get in a lousy business, get out of it.
And it's much better to buy something that's good at a fair price than something that is cheap at a bargain price. It just shows that even the most rational investor can be hijacked by a single moment of anger.
Speaking of things driven by ego and prohibitive cost, let's wrap up with a bonus geopolitical story from CNBC, the proposed Trump-class battleship.
Right. The president announced this new class, describing it as the fastest, biggest, and 100 times more powerful.
Defense experts were quick to categorize the proposal. Battleships are obsolete. The last one saw combat in 1991. They called it a prestige project and a bomb magnet.
And the financial reality is the biggest obstacle.
The cost estimate is upwards of $8 billion per ship, 2 to 3 times more than modern destroyers, and it runs completely counter to the Navy's modern strategy of distributed firepower.
So analysts are predicting its cancellation by a future administration is highly probable.
Very likely.
So what does this all mean when we put the entire mosaic together?
We've drilled down into a market that ended 2025 on a major contradiction. Record stock prices are masking severe underlying volatility. You have deep divisions at the Fed, a job market correction that exceeded 1 million layoffs.
In an AI sector where the spenders, like Oracle, are taking on massive debt.
Including that shocking $248 billion in hidden lease commitments, while the infrastructure monetizers like NVIDIA just keep consolidating power.
We've given you a shortcut to understanding where the real risks lie, not just in the market headlines, but in those specific footnotes, like Oracle's debt, and the emotional drivers, like the sheer spite that drove Buffett's revenge trade.
Now for the final thought for you to chew on. If a single moment of emotional anger over a fraction of a dollar cost Warren Buffett $200 billion in lost opportunity, what capital allocation mistakes are being driven by emotional hype right now in this AI-fueled market?
In which high-cost, strategically obsolete companies, like that proposed battleship, are doomed to be canceled due to sheer cost and strategic folly.
Heavy stuff to mull over this holiday weekend.
It is. Thanks for diving deep with us. We'll see you on Monday morning with new headlines from major financial magazines.